As 2023 comes to an end and a new year begins, the long-awaited normality still eludes global economy. The years 2020 to 2023 will perhaps go down in history as the period of great volatility, comprising a host of black swan events in quick succession. The global economy is showing signs of slowdown, though unevenly across geographies and sectors. The emerging market economies, that is EMEs, as a group have remained resilient during the current bout of volatility, unlike previous episodes. While headline inflation has receded from the highs of last year, it remains above target in many countries. Core inflation continues to be sticky, impeding the last mile of disinflation. Major central banks have kept rates on hold while refraining from forward guidance in view of the prevailing uncertainties. Financial markets remain volatile in their quest for definitive signals about the future path of interest rates. Against this unsettled global environment, the Indian economy presents a picture of resilience and momentum. The real gross domestic product, that is GDP growth for Q2 of the current financial year, has exceeded all forecasts. The fundamentals of the Indian economy remain strong, with banks and corporates showing healthier balance sheets, fiscal consolidation on course, external balance remaining eminently manageable, the forex reserves providing cushion against external shocks. These factors, combined with consumer and business optimism, create congenial conditions for sustained growth of the Indian economy. Looking ahead, it is our endeavor to further build on these fundamentals, which are the best buffer against global supply shocks in today's uncertain world. Let me now turn to the decisions and the deliberations of the Monetary Policy Committee, which was held, as you know, on 6th, 7th, and today 8th of December. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel, and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well, as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like